Inversion. We are talking REITs and property market. With us is BEATRICE MWANGI from CYTTON Investments to give us more in details into this. BEATRICE, welcome. And let's talk REITs, BEATRICE. What are REITs in the first place?
So a REIT is a regulated investment vehicle.
Yeah.
It owns, operates and finances a real estate property. This can be commercial buildings, it could be residential, it could be a warehouse. Yeah, so that's basically what it is. It means investing in real estate, not directly by owning the property, but by buying rights of that property.
Okay, so it could be, the most important aspect is a funding mechanism.
Yes.
For large real estate projects. It could be residential, it could be commercial, yeah.
When you are talking about buying rights into the property, so do you buy rights into a company that owns the property, or do you own the entire property? So for instance, if it's this building, how would a REIT own this building?
So a REIT owns this building. Okay. And you invest in that REIT.
As now the end consumer, as the end buyer.
And as the end buyer.
Okay.
So you get a portion of that ownership. You don't fully own the building, but you've bought into that building.
Instead of buying the whole building because you can't afford it.
It's a fractional ownership.
Yes.
So fractional ownership platform, yeah.
All right.
Yeah.
It does sound like an interesting way of getting access to the property market without having to raise a lot of capital as an investor.
And if you own a REIT, are you a shareholder or are you a REIT holder?
What are you?
You're an investor into that property,
meaning
any decisions that are made with regard to that property affect you. So you're basically involved in that property. Yeah.
Let's talk about the types of REITs. There are two types of REITs.
So we have two types of rates. The one is the income rate, and then there's a development rate. The income rate targets mainly an investment or a property that is supposed to be income generating. And then when you come to development, then targets property that is under construction and development. So that's the difference between the two. So in the I rate, the property is there. It's an income generating one. Some part of that ownership can be invested into construction, but it's restricted to around 50% of the total asset value. But for the development, then it's mainly you're buying into the development of that property. So that's the difference between those two.
Okay. And typically the income model for those two, the income rate, the I rate, is cash distribution at the end of the year. How about both of them are distribute cash?
Yes.
It's how do they generate cash? I rate and development rate.
So
is it more of a sales? You sell the property, or how's cash generation?
So for the income rate, the relation is the income is generated through income and capital gains. So that's where you get the dividends that you're going to be shared.
And talk about the rents
at the end of the job. Because it's income generating, meaning you're generating income from that property at the moment. For the development, then it's under construction, it's under development. So the returns come way later, but you also get returns from the development of that property. The value you get from that property.
So for the I rate, then they would go and buy properties, for instance, and then list them out or sell them. Can they actually buy properties to sell?
Most of them it's to list them out.
It's to list them out.
A relatively long period of time.
Okay.
So you're assured of income from that property over the time of the lease period.
So then their top line is they earn the rentals from all these properties that they own. And then part of that needs to cover for the management cost, right?
Yeah, sure.
And also maybe for the different consultants that they need to be able to ensure that this their facilities are working well. And then after that, whatever remains, the surplus is what is distributed.
It's what is shared. 80% of the income is shared.
80% of the income, if there's a surplus.
Definitely, they have to cater for all the expenses that are there. There's marketing, there's sales, and then there's that remaining part. And that, which is really 80% of the income, is what goes to the investors.
What happens if, for this I rate, that the managers have decided to take on debt to facilitate the acquisition of new assets?
So the problem with taking in the debt, then, before you are able to share that income, then you need to do those subtractions. So in case there's a huge debt, then the revenue that is going to be shared at the end of it all, then is a bit chopped.
It's reduced.
So it's reduced.
So in a way, if I want to invest in an I rate as an individual, then what I'm looking at is the structure and the strategy of acquisition of assets so that I can ensure that there's always a surplus that's been generated.
Yeah, true.
Or if I feel the expenses are too high and they will not generate a surplus, then it doesn't make sense because I won't make a return.
True.
Thank you.
And also property, when you're investing into property, you need to ensure that the rate the SPV you're working with, that special purpose vehicle,
the sponsor of the REIT,
has a very good property, because some of them will just buy property just to get the minimum requirements for CMA.
What is a good property?
A good property is a property that's able to give you a consistent good return.
What is a good return?
And a good return will depend on the market. For example, you're having a commercial building that can give you a rental yield of 8%. Other one can give you 10%. Other one can give you 4%.
Wow.
And what determines these returns or these yields is the rent they're able to charge.
Wow.
And if you have a prime property in a prime area, good location, very accessible, has a prime neighborhood, you expect to be able to charge a good rate or premium rents.
What are the asset returns, the yields that you're seeing? What's the best yield that you have seen on property?
As at right now, we would say for office, we have they're around 8.3% rental yield. It varies around there.
All right.
But if you look at very prime properties, they would go to a rental yield of around 13%.
Wow.
So if you're able to get a rate that is investing in a very good property, then you're sure your rental income is high. So your dividend at the end of it
this is on local currency.
This is in local currency.
Yeah.
Okay.
What about?
Have you seen some USD yields? What have you seen?
Never taken into those at the moment. I can't comment on that.
But what about commercial? Because what I'm trying to get at is you're saying an office would give me 8.3%, but that's over the long term. When we started the show, we were discussing the returns on the 15-year, so about 12%.
12 and a half.
12 and a half. Yeah. So, and then you're telling me the risks associated with an I-rate are they could have good properties, but then I don't have control over the cost. So then I don't know whether I have a surplus or not. So then does it make sense to invest at 8%? Or does it make sense for you to get into government bonds at 12%?
I think the advantage you have in real estate is the consistency of returns.
Consistency, okay.
Yeah, so they are not as volatile as others.
Okay.
So if you're targeting a 10% rental yield, then you're almost sure the fluctuation won't be much.
Okay.
There's not that much variance. So that gives you the assurance that if I invest in this property, even in the long run, I'm likely to maintain probably the same yield, and given the market trends, probably even higher.
Wow.
In the long run.
Okay, right. Wow. So, the uptake of REITs generally has been very low. Yeah, right. I mean, I remember when Stanley was listing the Fahadi REIT, I did some work around it, and one of the things we discovered was that the Kenyan mindset is all about capital gains, right? I'm buying a plot in Isinya, and the seller of the plot is telling you that one of the value proposition of the plot is the value of this plot is going to triple in 3 years. They buy this plot. Yeah. So when you want to start selling the concept of cash flows out of, let's take for instance this building here, the Jekwa Towers, you want to start telling the cash flow aspect of it, that every year this building generates X amount of cash flows. And when you buy into a REIT that has this property as an underlying asset, then you stand to benefit from the cash distribution every year. The average Kenyan mind struggle to look at that. They'd like to look at what's the value of this property in 3 years, rather than look at the cash flow aspect of it, which is the whole point of, for instance, an income REIT. Have you seen this as a problem from your end? Yeah,
the rates have been very unpopular to start with. They've been performing poorly. Even if you look at the subscription, initially when they were listed, it's very low.
Yeah. Even Fusion tried to sell a D-REIT and they not performed well. Yeah.
But maybe let's focus on the I-rate. I want to understand why there's no uptake on the I-rate, and then maybe why there's no uptake on the D-rate. Because the way you've described them, an I-rate you already have the asset there, but then the D-rate you're taking on additional risk because the development hasn't happened, so you don't know whether it will happen. So for the I-rate, maybe as George was asking, why do people not want to invest in it?
So I think first of all, with real estate, people are, or Kenyan minds are into property, tangible things that you can see, things that you fully own. Have this piece of land, not a building that we partially own.
Fractionally own.
Exactly. Yeah. So they want to own property on their own. But you see, if you come to developing property, then it's very capital intensive to have it on your own up to completion. So then the rates come in. But they've not been very popular. First of all, I think the main challenge is lack of knowledge. People don't really understand how this thing goes. First of all, you only have Stanley that you can actually talk about their performance at the moment.
Yeah.
If you look at how they're selling at now, the last time I checked, they were selling a unit price at around 9, and they started issuing at 20. So that's when half less than half the price.
Significant couple.
So I think it's the lack of knowledge that's there. People really don't understand how the REITs work, and the institutions have not come forward to even back them up. You know, if you had like several companies coming together and we're having this REIT, we're establishing, these are the deals you get, maybe people would buy more into them. I also think if the market was, the rates were divided into such, in cases like you're investing in a REIT that's focusing on affordable housing, on public servants units, then people who are interested in that sector are more lured into investing rather than just saying it's a commercial building. So you'd have maybe schemes investing into such property because they are probably interested in affordable housing. So I think it needs to be more customized and get more support and more knowledge in the market.
You've talked about affordable housing, Beatrice. Are you saying that the REIT would be something that can help the government fund the Big Four agenda with regards to housing?
First of all, the challenge you have at the moment is financing. If we can find alternative ways of raising finance, then it lowers the cost for developers, and also buyers are able to get houses more easily, because I think with the current capping of the interest rate, there's too much economic hassle that people are not able to raise money, both developers and buyers. So if you're able to find an easier way of raising money, then I think it would be the best way.
I think my last question on this section is then, what's the explanation or the rationale for why people are not interested in the D-rate, what Fusion Capital was trying to do?
I think it also goes to the opacity in knowledge. People don't really know how they're supposed to work, basically, because rarely have we had forums where people discuss the I-rate or the D-rate. And even when those that are there are existing, they don't come forward to say, how do we get returns from these investments? We don't have the publicly published financial statements clearing, stating the valuation of buildings, maybe, because if I'm investing in a certain building, then I know this is the value of this building. As an investor, I expect this much, this much was reported. There's no that transparency. So you don't take the risk into something that you don't know exactly how it's functioning.
You talk about transparency, and I think my view is that the market needs to embrace REITs, because REITs are going to solve two problems. One is that the price discovery in the market is quite opaque. The element of opacity permeates all the aspects of the market. Price discovery is a big problem. You don't know how people price houses. You know, someone just wakes up and thinks about a price and say this property is worth X amount of money, but you ask them, can you give me a calculation formula how you arrived at that value? They will not give it to you. And number two is that the property price indices that we have today, they're also not helping, because they're all based on ask and bid price. There's nobody who's doing an index on the actual transaction price, right? And REITs, because of the strict disclosure requirements, they actually disclose to you the list price. If they bought a property, they actually disclose the price. The tenants, they actually part of the disclosure, they actually give you the lease contracts, how long it is, the price per year, and that helps. If let's say a REIT bought a building next to my neighborhood, then it's easy to price and say, this building was bought, a REIT has just bought a building next to my neighborhood.
Then you can price.
At X price. And there's a formula to how they've arrived at it.
But if you're an investor, because you're saying as the person who's putting up the building, but I'm wondering if you're an investor and she's saying, for instance, the standard rate has moved from 20 to 9. If I bought a house in Lolongo, they go for 4 million. I don't know how they come up with it. We need that transparency. But if I bought it for 4 million, maybe last year, I still know my 4 million is there. But if I bought the Stanley rate, what you're telling me, my 4 million is slightly less than 2 million. So in a way, you're bringing out the element of, if I'm a builder, the rate helps me think about transparency and pricing. Especially pricing. If I'm an investor, the way you're describing it, I'm moving from 4 million to less than 2 million. Then how does that work? But it will adjust price. The whole point is that if someone comes and the price is out 30 million shillings, you don't know how they've priced that house, you know. You know the components of that price. Which one is the margin? Which one is the actual cost of construction? Nobody knows, you know. How do you actually look at it?
I actually think we lack a standard way of valuation of buildings.
That's the point. That's the point.
That's what we lack.
What do we need to do to address that problem?
I think first of all is have those standard measures or standard ways of valuing buildings. So if you know this building is valued at this amount, this is what they looked at. So if I'm an investor, then I know I'm able to go through that and actually understand.
So then you address what is bringing out.
Yeah. Secondly, I think professionalism or involving expertise.
Yeah.
So you're able to know the person who is dealing with this property is well equipped with information on the same.
Yeah.
So
do you have a template as a property analyst? So do you have a template, like if I told you this is the building that I want to be able to value, do you have a framework that actually helps you see whether there's value or no value?
So what we do personally, or at CYTTON rather.
Sorry, but I got to interrupt you because it's a market open and we need to ring the bell. See you shortly after the bell.